With us now, Gene Munster, managing partner at Deepwater Asset Management, and no doubt an inventor of many words. Gene, it's been a long week. We're glad to have you on the program. I saw Kevin Gordon of Schwab with a great tweet, as he is wont to do, that the PE, the forward multiple on the NASDAQ 100, is now about 20, down from over 30 just 5 months ago. At what point does this sell-off stop?
It stops with a catalyst, and I think the catalyst is beyond the geopolitical piece. What you've just described is beyond the geopolitical side, the sell-off here. And the catalysts come in the form probably of those Mag 7 that haven't had the big catalysts. And so, for example, we saw NVIDIA last Monday. They essentially took up their calendar 27 revenue growth from 30 to 40%, big step up there. Last quarter, when Meta reported, they took their numbers up from for growth for this March quarter from 25 to probably what's going to be 35%. So we've had some of these kind of resets higher, but I think the catalyst, to answer your question, comes in the form of some of these other companies that really haven't shined. And the closest catalyst amongst this group would be, of course, Tesla, with them reporting their deliveries next Thursday. We can talk more about those, but that's a potential catalyst. Obviously has fallen below the fold in terms of K metrics. But so there are catalysts, and then what we have coming kind of later in the spring, I think, from Apple, from Google on personalized AI.
Okay,
so
back it up.
I'm still optimistic.
Like that truck we're showing in the graphic, I want to back it up for a second, because do we know what the cause of this selling is? The war is obviously the easy answer for the market at large, right? Oil prices up, interest rates are up. But the sell-off began before the war began. All these highs were kind of hit July to October of last year. So is the war an add-on reason for the selling, or is it the main reason? I don't think so, but what is it?
Yeah, it's an add-on. I would probably put it at maybe 25% of this. The bigger topic, essentially what's going on here, and we started to see this back in the beginning of November, these numbers kept getting much higher, especially for the big companies. And it just created this concern that it really couldn't get much better, this idea of that the growth is going to somehow slow. I think what's kind of represents this in its purest form was, again, that step up in guidance that NVIDIA gave for next year from 30 to 40%. The stock traded off 8% in the following 2.5 days after that comment. The NASDAQ was down about 3% during that period. And what that tells me is, even me being optimistic, I wasn't expecting them to make that strong of a guide. And so what I think we're really underscoring here is that this idea about the sustainability of AI, this concern that it is not sustainable, I think is underwriting what this sell-off has been. And so, this is going to be the challenge here, is that if you're a big believer, which I am, that the substance of AI is going to far exceed the hype, if you're in that camp, what's going to be the trigger as these companies continue to beat numbers? Of course, then the bar gets even higher for that out-year growth. And so that's the piece I feel really good about, the fundamentals, kind of triggering or trying to define at what point the investors come to grips with this is going to be growing higher for longer. That timing and that dynamic is the piece that I think is going to be more difficult to manage.
Gene, the thing on my mind, you go back 10, 15 years, and so many guests on our airwaves, or, I talk to people, and anyone who's sold one of these big tech platforms often comes to regret it, given the performance that they've had. But do you think that these companies fundamentally can grow wealth over the next 5, 10, 15 years like they did in the past? Are we chasing a dream from a former era?
Well, I think that not of all are created equal, of course. In the case of Microsoft, I'm a believer that they're going to be more challenged. You talked about that 63% upside to the average price target. I mean, I think that the consensus is it's a buy down here, the contrarian consensus. I think, Kelly, that that's an example of a company that's going to be impacted on a seat growth basis. But a lot of these companies, we recently increased our position around Apple. And part of the reason was after Opus 4 came out and what we saw with this personalized AI, I think that there is a massive opportunity for Apple really to get this right. I think Google also has a similar opportunity. And so I do believe that some of these companies should fundamentally be owned. I also believe that if you're looking for outperformance, I think you need to own the AI trade outside of the Mag 7 or